welcome to Sectors Up Close. I'm Elena Casas. Today we're going to tackle the outlook for European equities, and our guest is FTSE Russell's Head of Global Investment Research for EMEA, Marlies van Boven. Well, following close on the heels of Wall Street's blockbuster performance last year were European equities. While stocks in the UK languished, main markets on the continent fared much better. The FTSE Developed Europe ex-UK index rose 22.4% last year, and like its US peers, it's seen a significant correction so far in 2022. This index is down 7% so far this year, including a 4% drop just yesterday. But this benchmark and others like it differ from Wall Street in the companies that dominate them. In the US, Apple, Microsoft and other big tech take up a huge chunk of market capitalization, while in Europe about 23% of the market is these 10 companies. They include food maker Nestlé, chip equipment maker ASML, drug makers such as Roche and luxury brands such as LVMH. The only tech component here is software maker SAP, representing about 1.75% of the index. So, how will this and other factors affect the outlook for 2022? I'm now joined by FTSE Russell's Marlies van Boven. Marlies, hi. How do you think the outlook for European equities will play out differently to in the US over the next year?
Thank you, Elena. Well, the Fed started signaling faster unwinding of their emergent stimulus and interest rate hikes. And that has benefited value as growth stocks have a longer duration and they are at risk when interest rates rise. So what we have seen is like a strong sell-off in tech, strong in US, and it has a larger weight there. So 10% sell-off, 30% of the market, followed by a ripple effect to healthcare, consumer discretionary, all selling off more than 10%. In Europe, the loss in tech was compensated by a larger exposure to financials. We did well. It held up at 3.6%. So in all, Europe is down just 2%. If we think about the outlook, so what has happened in Europe, there was the response to the outbreak of the virus at the end of the year and at the start of this year has been very different in Europe relative to the US. So in Europe, lockdowns have been imposed. And this could be then to economic growth. So that could be a problem. This together with the already high energy prices, which has crunched real income of the consumers. So consumers feel quite relatively poor and not kind of willing to spend their large savings. So there are a few risks to economic growth hanging over Europe.
Of course, much of the sell-off in tech in the US is being sparked by concern about the Fed raising rates quite aggressively. We'd expect the ECB to take a different course, won't we? So how is that likely to play out?
That's true. So the ECB is still firmly dovish. So they plan to start unwinding their emergency stimulus slowly over the course of the year, with the potential interest rate hikes in 2023, conditional on core inflation hitting their target of 2% on a more consistent basis. So it's very big contrast with the US, who's signaling faster than expected unwinding. If we look at the Europe, so it did quite well in 2021, 5% GDP growth, almost compensating for the 6.5% lost the year before. But there are some darker clouds hanging over Europe as well. Given the reaction to the outbreak of the pandemic and the local lockdowns in countries such as Germany, the Netherlands, Austria, this is a threat to the growth picture. Also,
as Europe struggles to recover from those lockdowns, then what do you think the biggest risks are in the year ahead?
Well, energy prices are at a 7-year high, and of course, there's a risk of there's a real risk now that Russia's putting pressure or invading Ukraine, which could put more pressure on oil prices, which is inflationary. Europe is very dependent on Russian gas. So that would be a big issue. If there's further inflation from energy, this will directly hit the consumer. So their confidence is already quite low since the renewed outbreak of the pandemic. This could further crunch their confidence. and limit consumer spending, which could dent economic growth.
Where do you see the bright spots then in European stocks for the year ahead? Which sectors are likely to do best?
Well, Europe is quite well positioned for steepening of the yield curve, given its large exposure to financials and also cyclical sensitive sectors like materials, industrials. This, of course, and a relatively low percentage of tech. But this will still require a positive kind of economic outlook. Other sectors, Europe is very export focused, so it has quite a global outlook. A pickup in demand in China would benefit exporting countries such as Germany, the car manufacturers, some industrials, some electronic makers. So there are some bright spots, but we have to see how the economy evolves over the next few months.
Thanks so much for that insight, Marlies van Boven, Head of Global Investment Research EMEA at FTSE Russell. Well, before I go, here are some of the top stories in the space. German business morale improved in January for the first time in 7 months. The easing of supply bottlenecks lifted the outlook for manufacturers in Europe's largest economy. The IFO Institute said company executives were considerably more upbeat about their outlook, while their assessment of current conditions was less so. The IFO figures chimed with market PMI data out on Monday, which also showed a relaxation in supply chains, helped push up manufacturing activity to a 5-month high. Ericsson beat forecasts in the fourth quarter, helped by booming demand for 5G network gear, but Sweden's strained relations with China continues to weigh on sales there. The network equipment maker saw adjusted profit climb to almost $1.3 billion, while cash flow hit record levels. Its sales grew in Europe, North America and Latin America, despite competition from a resurgent Nokia. But China remains a drag. Once a big player there, Ericsson has been largely frozen out following Sweden's ban on Huawei. Ericsson also said its next set of earnings will take a hit from a court battle with Apple over royalty payments for the use of 5G technology in iPhones. And Credit Suisse has warned that it will post a fourth quarter loss of around $1.75 billion as the scandal-hit lender flagged fresh legal costs and said business in its trading and wealth management divisions had slowed. It pointed to a downturn in Asia, plus a return to more normal trading conditions following a bumper couple of years. It's also due to make a fresh legal payment of about $544 million to settle legacy cases related to its investment bank as it tries to change a freewheeling culture that has cost it billions and led to a series of scandals. And that's your look at the European equities outlook. I'm Elena Casas, and this is Reuters.